Let's connect with Pankaj Pandey, Head of Research with ICICI Direct. Pankaj, even though the month of November has been slightly choppy and sloppy for Indian markets, I guess the market trajectory is very clear, which is that it is on course to make lower lows and higher highs.
Nikunj, if you look at from a YTD perspective, markets have done nothing, and I think in this particular quarter also, which has gone by, if you look at the top performing sectors have been IT and pharma. FMCG, the revenues have come down in single digit, the growth rates. Besides that, I think the surprise was auto, wherein Tata Motors did the job for the entire sector. So in that sense, if you look at, we haven't seen too much of a broad-based recovery, and going forward also, since these defensives contribute about 36% by weightage to Sensex, and typically would be growing in the range of 15 to 20 odd percent. So 6 to 7% kind of a Sensex EPS growth is what one can easily look at. And plus, if there's some positive recovery, again, you would see the markets delivering either single digits or lower double digits. So that is what is possible over the next 1 year. And I think the sectors which have continued to do well will continue to do well, and I would not really want to jump to the cyclical part, because I still believe that in a rising interest rate scenario, it is difficult to assume that we'll see a broad-based recovery happening.
So Pankaj, do you think the market will become, will remain range-bound with 6,000 as a floor being intact and perhaps 6,200 thereabouts at the top?
Well, yes. I think if you look at, like I said, on a YTD basis, markets would have done 4 to 5% kind of a appreciation. Within Nifty, if you look at on a YTD basis, only 17 stocks are there in the positive territory. Rest, all of them are negative as of now. And also, if you look at from earnings perspective, again, it is skewed towards the defensives. So as of now, there's nothing to suggest that we'll see a sort of a broad-based recovery, and we are trading at 15.5 times kind of a multiple, so which is quite valued. So the markets would sort of trend on the basis of earnings growth, which is likely to be a mid-single digit, a good single digit to a lower double digit kind of a range. So that is what the best can be expected from the market, given there is a limited scope for multiples to expand.
Pankaj, but for those who focused on earnings, they've not really made money in last 2 years, because the big story, the big trend in last 2 years has been that more than earning expansion, we've seen a P expansion. At a time when global liquidity is likely to remain benign, should one worry about earnings at all?
I think earnings is the only margin of safety which one can look at. Probably if you look at this year, FMCG is witnessing more of a time correction rather than price correction, which is still a better thing to expect in a market condition like this. Your IT and pharma are classic examples. So if you look at in this particular quarter, 30% is the kind of both top line is the kind of top line growth both the sectors have delivered. And on a YTD basis, if you look at IT would have done about 48 odd percent, and pharma would have delivered something on these lines at about 24-25%. And going forward also, if these sectors will continue to sort of deliver this kind of a growth rate, that is what is expected. At least that is what we have seen some of the leading pharma companies, say for example Sun and Lupin. They continue to be expensive, but then again they have been delivering a very consistent set of numbers, and that is why the market has been rewarding them on a consistent basis. And same is likely to happen in IT. So we expect that the IT sector will continue to do well, and it does not look that expensive given the kind of growth rates it will deliver.
Pankaj, what about the OMC trade? Does it remain a trade, or do you think there is meat in buying into these stocks from an investment perspective, purely in the light of the crude cool-off?
I think if you look at, it does not look like the government is going to do one-time price hike on the diesel front, which means that in an election bound year, we would not expect something magical to happen in this particular sector. Having said that, if you look at the upstream companies, the ONGC, Oil India, or even for that matter, Cain would be trading in the multiples of 5 to 6 times, which would look quite cheap. But having said that, we do not expect much to change over the next 1 year, and which is why one should not be really chasing these stocks. We don't expect there will be a big crack in the crude oil prices. So which is why I think from a trade perspective also it may not make that greater sense. From investment perspective, obviously we would not really be sort of very positive on this entire sector as a whole. But within this pack, the upstream companies look quite decent.
Okay, the other talking point today has to be United Spirits. Even though the outlook for FMCG in general has not been very constructive, United Spirits, even though they came out with ordinary set of numbers, has been a performing stock. Let's look at United Spirits in last 4 trading sessions, or last 5 trading sessions. The stock has appreciated by about 10% plus. The news there is there on your screen. Most of the market participants are of the view that Diageo will be able to fix the balance sheet of United Spirits. The balance sheet has a huge debt issue, and if indeed Diageo is able to sell their stake in White and McKay, United Spirits, the debt will come down, the return on equity will improve, and cash flow will improve. Typically, FMCG companies globally don't have a debt burden, but because United Spirits has a debt burden, it is trading at a deep discount to other FMCG stocks. If Diageo is able to turn it around, we really could see a huge P expansion in United Spirits. Pankaj, would you be a buyer in United Spirits? Diageo is clearly getting the act together, and if they are able to fix the balance sheet of United Spirits, this could be a big winner even after the recent run-up.
Nikunj, I have not been tracking this stock, and we don't cover it also, so I will not be able to comment on it. But I think within the FMCG pack, this sector is still quite regulated, and I think that is where the concern would be, because a lot of state governments do buying on a quotation basis, which again is quite subjective, like what we have seen in the state like Tamil Nadu. So I think it will not really be as good as the other FMCG counters. That is what my expectation or my belief would be.
Pankaj, you mentioned that you are not hot on cyclicals. Any reason why you are not hot on cyclical stocks? Because one would imagine that the rate of change now for cyclicals would be strong, and the rate of change for FMCG and IT may not be all that positive.
Well, Nikunj, if you look at a number of these cyclical counters would have done well. Say, for example, you have Shipping Corporation of India. From bottom, it would have given about 25% kind of a return. A company like SAIL would have delivered closer to 100% kind of a return. But then again, if you look at Shipping Corporation of India, we don't expect it to sort of make profits over the next 2 years. So, which is why we would be not comfortable recommending a stock like that. Though on a return basis, it might do more or compared or would have delivered more than the entire pharma sector. But then again, I think somewhere down the line the comfort is not there. Plus, if you look at a number of infra-related sectors on a broad basis, at least 85% of the EBITDA is still going towards paying higher interest rates, and which as of now we are not done away with. So we are yet to sort of factor in when the rate cuts will happen and how much. So in that sense, we would still believe that the sector will continue to struggle. You look at sectors like cement and steel, the demand is about 2-3%, which is really not a very great sort of demand which one can look at. So we are yet to see any signs of visible improvement. So it is just recovery, and we don't see any kind of a progressive recovery in most of these sectors as of now, which is why one should still stay away from these stocks.
Now, Kane India, the board will meet today to consider a buyback. Do you think the management is doing the right thing by considering a buyback?
Well, if you look at, they have reserves, cash reserves in excess of about $3 billion, and even with whatever dividend payouts and other capex plans, they would still have a good amount of surplus. So even if they are utilizing about $1 billion, I think that would make a lot of sense for investors. We have a target price of 364. Like I said, the stock is cheap at 5 times, but there were recent concerns that the production may not really ramp up to unexpected lines, which is why we had a bit of a lowering of our production target for FY14 and FY15. But the integrated development plan hopes that the company would be able to achieve about 3 lakh barrels per day of production going forward, so which is a long-term positive. But it does make sense, and it does give a visibility on the cash utilization front, which is positive for the stock.
So at the current level, would you be a buyer in Kane?
See, if you look at from a longer term perspective, like I said, for a 1 or 2 year perspective, these stocks have been quite attractive. But like I said, we would not really be expecting a big crack or big jump in crude oil prices, and production numbers would be slightly sort of stable. The integrated plan might take a longer time to shape. So over the next 1 or 2 years, from that perspective, I would not be really a great buyer in the stock.
As a house, you have a strong buy recommendation on Bharti. Why should one buy into Bharti now? Because it's no longer a cheap stock. The run-up from the recent low is quite extraordinary, and still there is no clarity on what will happen to the spectrum pricing.
Correct, Nikunj. We had a strong buy on Bharti, and in fact, around Diwali we had recommended booking profits into the counter. We believe that the stock has run up fairly decently, and I think overall going forward, we still like this sector, but I think we believe that there are still some more concerns on the spectrum pricing front, so which I think should eventually benefit incumbent players. And though I think the clarity might might put some pressure on the stock, but we still believe that both Idea and Bharti should do well from current levels. So Bharti, we have a target price of 385, Idea about 193. But since we had given this recommendation quite long back, and we did some bit of a bottom-up buying also, so in that sense we had recommended booking of profit in this specific stock. As of now, we are not saying a fresh buy into this particular stock. Longer term, we are still positive on this stock.
Pankaj, of late FMCG stocks have done precious little. ITC, HUL, Britannia, they have been marked underperformers. But the outlier here seems to be Asian Paints, an expensive stock, and which is up 14-15% this year.
Correct. Nikunj, if you look at FMCG as entire pack would have delivered about 9% kind of a performance in terms of price as an index. So we have seen more sort of a time-based correction in the FMCG pack. But Asian Paints has done quite well. In fact, contrary to our expectation, the volume growth has been quite positive. So which again means that there's some demand, especially on the rural side, which might be sort of helping the stock. But yes, it does stand out within the entire pack in terms of the overall numbers. But having said that, a lot of that is there in the prices. So on an absolute basis, we would not be really chasing this stock. But yes, it does offer a good insight into the kind of volume growth which other players can also look at. So in fact, Dabur also, if you look at, has been on a brighter side on the volume side, because again it has got a more portfolio tilted towards the rural side. So I guess that is what would have been driving the demand.